Welcome to this Bell Direct weekly update. I'm Julia Lee, an equity strategist at Bell Direct. And given the spike in volatility and the losses in the market this week, it's no wonder that most investment houses are focusing in on whether this is a correction or the start of a deeper bear market. Starting off with Investec, which says that despite some risks that shares are entering a bear market after the shortfalls this week, most historical triggers like imminent recession, inverted yield curve, and significant earnings downgrades are not yet in place, and overall valuations and sentiment are not that extended. Overall, we are late in the cycle and the balance of risk versus reward has been deteriorating for some time, so incrementally a more cautious stance does make sense, but it does seem too soon to become outright defensive. For now, this seems to be a correction in a bull market in response to escalating trade tensions and an end to monetary policy support. The odds favour equity weakness over the next few weeks and some consolidation before continuing on that bull market. Having a look at Macquarie and some of the China fears, given that we have seen a deep deterioration in the Chinese stock market, there are expectations of an inevitable crisis in China, but expectations of a crisis in Japan have also been overblown for years, and this is because Japan has never been a conventional capitalist economy. Similar expectations of a debt crisis surround China. After all, the credit bubble has grown at an even faster pace than in Japan. And it's true that China's headline debt has increased from 1.5 trillion US dollars in 2000 to 38 trillion US dollars today, which is the fastest accumulation in history. But most of it is housed in state or quasi-state entities. Hence, commercial risks are manageable and China can recapitalize its economy, Macquarie says. Let's have a look at Shaw, having a look at some value ideas and focusing in on some of those more defensive plays. One of their picks is Capital Health in the healthcare and government space because government spend is strong. There's a strong balance sheet and a share buyback. IGL, or IVE as the company is called, is a marketing business. It's a large diversified business with long-term customers, balance sheet deleveraging and earnings uplift through synergies. It also likes Huon Aquaculture, HUO, a large salmon producer in Australia with strong international and domestic salmon pricing and an improving aquaculture profile. And it likes Ripe RHP, which is software as a service, cloud-based reseller for large tech companies. So plenty of defensive ideas there. It says that its basket of defensive type stocks has a much lower PE ratio than the small cap index and also looks stronger in terms of gearing. Having a look at Morgan Stanley and housing, their base case scenario for Australian housing is a prolonged orderly house price correction of 10 to 15% from the peak. They see commencements slowing throughout 2019, but their base case, they say, still supports being overweight Lendlease as well as Stockland. And having a look at what's likely to move the markets in the week ahead. And it's third quarter earnings season over in the US, where growth of 19.2% is expected. That would make it the 6 out of 7 quarters of double-digit growth in earnings. Earnings growth is expected to be the highest in energy, finance, construction, materials, and technology. So hopefully we see a bit of a rest from the market volatility and a refocus in on fundamentals and earnings. I'm Julia Lee, an equity strategist at Bell Direct. Hope to see you next week.